Two of the biggest companies on Earth reported earnings within about an hour of each other. Both of them said the same thing. We are spending an unprecedented amount of money on artificial intelligence, and we are going to spend even more next year. One of them went up roughly 15%. The other fell about 10%. And here is the part that breaks the obvious explanation. The company that went up is the one spending more. A lot more. Microsoft guided capital spending to $255 to $260 billion. Meta guided to 130 to 145. So it is not the size of the spend. Something else got priced yesterday. And once you see it, you cannot unsee it in any artificial intelligence stock again. So let's take it apart. Start with what almost everyone believes because it is reasonable, and for about 2 years it was correct. The consensus goes like this. Artificial intelligence capital spending is one trade. Every hyperscaler is pouring tens of billions into the same chips, the same data centers, the same power contracts, and none of them can prove the payback yet. So they rise together on optimism and they fall together on doubt. Under that model, a quarter where everyone raises spending is bearish for everyone. Same risk, same names, same direction. And you can see why that reading stuck. For most of this cycle, it was just true. When one of them raised a capital spending guide, the whole complex traded off. The market was pricing the bet, not the builders. And this week, Meta looked exactly like that story. So let's be fair to it and start with what actually went right. Because the headline number was good. Revenue came in at $60.8 billion, up 28%, and it beat expectations by something like $620 million. That is not a broken business. That is an advertising machine still compounding at nearly 30% at enormous scale. Then you go one line down. Earnings per share came in at $6.18 against expectations of $7.10, a clear miss. And then you get to the line that actually did the damage. Free cash flow. A year ago, it was $8.5 billion for the quarter. This quarter, it was $784 million. That is a fall of about 91%. The company generated $31.9 billion of operating cash flow and spent $31.1 billion of it on artificial intelligence infrastructure, servers, data centers, networking, chips. Almost every dollar the business produced went straight back out the door. And then management raised the spending guide for the year to a range of $130 to $145 billion, up from $113 to $128. The stock fell about 10%. So far, the consensus story works perfectly. Huge spending, collapsing cash, stock punished. Except, on the very same afternoon, Microsoft reported, revenue $90 billion, up 18% against expectations of 87.6. Adjusted earnings of $4.74 against expectations of $4.24. That is not a small beat. That is a 50-cent beat on a $4 number. And then Microsoft told the market it plans to spend $255 to $260 billion on capital projects in its next fiscal year. Read that again next to Meta's number. Microsoft is guiding to nearly twice the spending, and its stock rose about 15%. If the consensus model were right, that is impossible. Same trade, same risk, same direction. It did not happen. So the model is wrong, and we need a better one. Here is the better model, and it is almost embarrassingly simple. The market is no longer asking, how much are you spending? It is asking, when you spend $1 on artificial intelligence, is there a meter attached to it? A meter is a mechanism that converts that capital into billed revenue in the same quarter you spend it. Not eventually. Not in the roadmap. Now, think about what Azure actually is. Microsoft buys the chips, builds the data center, powers it, and then rents that capacity out by the hour to companies who put a credit card down. The moment the capacity is live, it is metered. Every unit of compute that gets consumed shows up on an invoice. So when Microsoft says it is spending $255 billion, an investor can look at that and see the other side of the trade in the revenue line. Now, think about what Meta's spending is. Meta is buying largely the same chips and building largely the same data centers and pointing them at recommendation systems, ranking models, and its own assistants. Those things may well be enormously valuable. They may already be improving advertising performance, but there is no invoice. Nobody outside Meta is paying by the hour to use that compute. The capital goes in one side, and what comes out the other side is a product improvement, expressed as a hope about future engagement. Same chips, same buildings. Completely different accounting story. And this is the number that made it undeniable. Azure grew 43% in constant currency. Not just big, accelerating up from 40% the previous quarter, against a consensus of 40.2. Full-year Azure revenue crossed $100 billion for the first time in its history. And then the chief financial officer guided the next quarter to 45%, when the street was modeling 41.4. That is a business whose constraint is not demand. It is how fast they can physically build. So look at the two numbers side by side, plus 43% and minus 91%. Both companies made the same bet on the same technology in the same week. In one of them, the spending is visibly arriving as revenue while it is still being spent. In the other, the spending is visibly leaving, and the arrival is a promise. That gap is the entire re-rating. So here is the kicker, and it is the opposite of what most people took away from this week. The market did not turn against artificial intelligence spending. It approved the largest capital spending guide in the history of corporate America on the very same day. What it did was stop grading spending on faith and start auditing it. And that is a genuinely new regime. For 2 years, a big capital spending number was read as a signal of ambition, and ambition was rewarded. From this week, a big capital spending number is a question. Show me the meter. If you can, you get funded and re-rated. If you cannot, that same number gets read as a hole in the cash flow statement. And if you want evidence that this is a real economic mechanism and not just a two-stock coincidence, look one layer down the stack, at the companies that sell human hours instead of compute. Infosys, one of the largest technology services firms in the world, trimmed the top end of its full-year growth guidance in constant currency to 3% from 3.5%. Small on its face. But read the reason the company gave. Muted enterprise demand, and clients reprioritizing budgets toward artificial intelligence they run themselves. Sit with that for a second, because it is the same mechanism from the other side. Corporate customers are moving money out of billable outsourced hours and into platforms with a meter. Which means the money Microsoft is metering is, at least partly, money that used to be somebody else's revenue. Notice what did not happen in that sentence. Nobody's job was automated by a robot. A procurement line moved. That is what the first real revenue casualty of artificial intelligence actually looks like. And it is showing up on an income statement long before it shows up in a jobs report. Now, let me argue against myself, because this read has a real weakness, and you should hear it from me rather than from your losses. The strongest counterargument is timing. Meter revenue is not the only kind of revenue that counts. Amazon spent years building infrastructure that looked like a hole in the accounts before anyone would pay for it. If Meta's spending genuinely improves advertising targeting, that money arrives. It just arrives later. And it arrives disguised as higher revenue per user rather than as a cloud invoice. Under that reading, the market is not auditing anything. It is simply impatient, and it is discounting Meta for the sin of a longer payback period. And there is a second, more uncomfortable version. Metered revenue can be circular. If a meaningful share of the compute being rented is being rented by companies who are themselves funded by the artificial intelligence boom, then the meter is measuring real cash, but the cash is coming from the same pool. That is a legitimate risk, and it is not visible in a single quarter's growth rate. So here is how we would know we are wrong. If Meta's next 2 quarters show accelerating revenue per user while spending stays elevated, the meter framework does not explain it, and impatience does. We will say so. So, the read. Artificial intelligence is no longer one trade, and treating it as one is now the expensive mistake. The dividing line is not chips versus software, or big versus small. It is metered versus promised. And that line got drawn this week in public, on the 2 largest capital spending budgets ever announced. Here is the falsifiable version, dated today. We think at least one more major technology services firm cuts or trims full year guidance citing artificial intelligence reprioritization within the next 2 quarters, because Infosys is the first print of a pattern and not an isolated miss. If Accenture, Cognizant, Wipro, and Tata Consultancy all hold or raise through the next 2 reporting cycles, we were wrong and we will mark it. And the test is tonight. Apple and Amazon report after the bell, and both of them sit on the interesting side of this line. Amazon runs the largest metered compute business on Earth. Apple runs the largest promised one. Options are implying about a 6.6% move in Amazon and about 3.4% in Apple. Watch which one gets asked to show its meter. So that is the whole thing. The market did not stop believing in artificial intelligence this week. It started asking for the invoice. It is not how much they spend. It is whether anyone is billed for it. So here is my question for you. Is the meter a genuinely better test? Or is it just the market being impatient with anyone whose payback takes longer than 90 days? Because those 2 readings look identical today, and they end in completely different places. Tell me below. I'm Frankie, the asymmetric signal. One contrarian read a day. Subscribe. Research and education only, never investment advice.